Good morning. We would like to welcome you to our first Better Your Business Express training. Today we're offering the first of 4 spring trainings that are brought to you in a unique and exciting partnership between the university centers at the University Center, which represents a partnership between Dixie State University and Southern Utah University, at our innovation centers and professional development departments. So we're able to bring those trainings to you because of a grant that has been gifted to our community as part of the EDA CARES recovery program. And just a little bit of background, we have been surveying the community for the past about 6 months, trying to identify what are some of the real needs that business owners and professionals have at this time, and to help prepare you to reopen with confidence and also be ready to make adaptations that are really going to be necessary moving forward and really specific and local to Southern Utah. So my name is Melinda Thorpe. I am the Executive Director at SUU's Community and Professional Development Department. And as we welcome you this morning to the Better Your Business Express, we want to invite you to share with us as we go any ideas about training topics that you specifically see that you need for your business. The grant is given to our community for the next 2 years. And as the University Center, our partnership between SUU and Dixie State, our role is to find and facilitate the trainers that you need as business leaders. And so we will curate and find experts that meet the needs that you identify for us and bring them to you. And so we're really excited about our role, the role that the universities get to play. But most importantly, the grant is intended to help our region, the 5 counties here in Southern Utah, recover and reopen. And as we go, our trainings are lined up in increments of 4 at a time so that we can be adaptive as economy or needs might change. So we're really excited to be here with you, to be able to present this program. And we really want it to be interactive. Have you tell us what you need. We'll find the expert to bring you the training. So as I mentioned, we've done some initial surveying and identified our first 4 topics. And we're excited to bring to you some financial training today from our friends at Hinton Burdick. So before we get into the presentation, I really want to introduce you to the team that is behind standing up and delivering this program to you. And again, we like to call ourselves the ears of this program. We're listening to what your needs are, and then we'll find resources to bring you the knowledge and the skills and the trainings that you need. So upcoming in this series, we have how to adapt your business to an online marketplace if you need help building a website or updating your website to be relevant to your online customers. We have a customer service and a branding and a positioning training to help you learn some of the key messaging that you can use to help people feel comfortable and confident in re-engaging with your business. In terms of safety and also being relevant and helping your customer base understand that you're aware of what their current needs are. So the team behind the Better Your Business Express is myself, and then I want to just shout out to my team. If you'll wave on the call as I introduce you. So Susie Knudsen is here with me at Southern Utah University. Susie serves as the assistant director in our department here in community and professional development, and also Tanner Vario, who is our program manager. And we're happy to have you both on the call with us this morning. And then our friends from Dixie State University, Colby Jenkins, who is the director at the Innovation Plaza, and also Colette Cox, who you'll get to interact with here a little bit more on today's broadcast. So she is the outreach manager at Dixie State University and is located at the Innovation Plaza in St. George. So from Cedar City and St. George, SUU and Dixie State University, we're excited to be here to serve you over the next 2 years. So with that, I'll turn the time over to Susie, who will go through a couple of matters of business for us this morning.
Good morning and welcome to our training. We wanted to let you know that this training is being recorded and including audio and attachments for record keeping and educational purposes, and it will be shared online after this meeting. Today, we're excited to hear from Candace Tibbetts and her team from Hinton Burdick CPAs and Advisors about a variety of CARES funding programs still available. Welcome, Candace. Please introduce yourself and your team presenting today.
Well, thanks for having us. So my name is Candace Tibbetts. I am born and raised Southern Utah. I actually attended Dixie State when it was Dixie College and got my bachelor's there, and then received my master's from SUU. So I am in the fan club of both. So there you go. I've been in accounting for 15 years. Love it, every bit of it. This last year, I have been all about business stimulus at Hinton Burdick, and it's been amazing that I am able to work with a group of individuals where I got to focus on the stimulus, which is pretty cool. So with me today, you won't see them on the camera, but they're here in voice and presentation is Dalton Habrel and Sil Bundy. Do you guys want to say hello and introduce yourselves?
Yeah, okay, I'm Sil Bundy. I've been here at Hinton Burdick for a few years, and I graduated from Dixie State University as well. And I've been a part of the PPP and other stimulus team here at Hinton Burdick for the last year as well. And it's been an adventure for sure. So we're glad to be here.
Yeah, my name is Dalton Habrel. I've been at Hinton Burdick just a bit. I did go to Dixie College, same as Candace, when it was college, but then I left and went to Utah State, and now I'm back, but I am from here and glad to be here.
So we're going to start today with business stimulus for 2020 and 21. So some of it is still available retroactive to 2020 if you were an active business then. So some of the specific stimulus packages we're going to talk about are the Family First Corona Response, the Employee Retention Credit, the Payroll Protection Program, and the Restaurant and Special Venue Operators Grants. And then we'll absolutely follow up with questions. So please feel free to put those in the chat. And we'll try to pause at the end of each stimulus section. If there are specific questions to that section, we can address them as we go. So this has been a crazy year. So as you can see from this slide, there has been 7 different stimulus packages that all have affected businesses and individuals in the last 12 months. I don't know how much you know about Congress and all of that, but this is pretty crazy to have this many changes in a year's time period. Also, the interesting thing about the changes is I can tell you how it stands today, but that doesn't mean that's how it's going to be a week from now. So a lot of this is very fluid still. Some of it is set in stone, but a lot of it is still ever changing as Congress and the president try to adapt to needs and requests. So the first one we're going to talk about is the Family First coronavirus. So this program was mandatory for all employers. If you were really small, there was an option to elect out. And that was from April 1st through December 30th, 2020. So then there was changes made at the end of December and then changes again March 11th. So let's just go over the program really quick and then go from there. So when the Family First Response Act came out, it was about paying people, the government subsidizing sick pay for employees. So employees were eligible for up to 80 hours, essentially 2 weeks of pay. And that could be if they were affected by COVID, a member of their family was affected by COVID. There was limits put on to those limits were $511 a day or $5,111 total. It was available to pretty much everybody. And it was very helpful for a lot of people who were struggling. Also with the sick pay, they put out Family Medical Leave Act extension. So typically Family Medical Leave Act is only for employers who have more than 50 employees. And because it can be very difficult for employers to do it, to offer it and to live within the regulations. So the way this extension worked is they actually allowed and helped pay for those who needed to stay home because schools were closed for the children, even some daycares were closed. And so essentially they were trying to help those working families who couldn't go to work because they needed to take care of family. So these tax credits were taken on your payroll tax forms. So that would have been the 941 form. And we're a part of, that's how the government helped get the money back to the employers who were providing these subsidies. So this, again, was from April 1st of 2020 through December 31st of 2020. So then the Appropriations Act, it did two things. It was no longer mandatory, but the employers could elect to continue it, and it made it extend through March 31st of 2021. So it provided another 3-month extension on that. So with the third bill, the American Rescue Plan Act, they call it ARPA. There'll be a lot of acronyms throughout this presentation. I'm sorry about that. So not only did ARPA extend the sick and family medical leave, it also did a restart for sick leave. So that means if I utilized the sick leave back in December because my child was sick, then potentially if I get COVID now between April and September and my employer does elect into doing this program, I could get an additional 80 hours of sick leave that's subsidized by this ARPA plan. It also added a couple additional qualifying events. So if I go to get my COVID vaccine, my time off of work can be compensated. If I have complications from my COVID vaccine, I can be compensated up to those 80 hours. And then if I'm waiting for a COVID test, that's considered a period of time in which I could be compensated. So that's sick leave. The family medical leave wasn't reset, but they did extend the same qualifying reasons to the family medical leave. And so that means it could be if you're assisting with taking a dependent, a spouse to get the COVID vaccine, or taking care of somebody that has complications with the COVID vaccine. So, so that is the Family First in a nutshell. Do we have any questions on that before we move on? All right, awesome. So the Payroll Protection Program loan and forgiveness, we're going to kind of lump them together. So the Payroll Protection Program loan came out the end of March of last year. The qualifications for getting this were very non-restrictive. So a lot of people participated in this program, and they actually ran out of funding within 7 days. So the April 24th Payroll Protection Program and Health Enhancement Act, it provided additional funding for the program itself. And then the funding, we hadn't used all the funding yet, so the Payroll Protection Flexibility Act just extended that deadline. So there was a period from April to August of 2020 that was eligible for your initial application, and then the program was closed. The program was reopened with the Consolidated Appropriations Act that happened in December, and so it was reopened and then extended. So that is what we call PPP2, meaning you can have a first draw and a second draw. And so let's just move on to the next slide. I think it talks about those. So the Payroll Protection Program first draw, the qualifications were very simple. It was necessary for the continuation of your business. The amount of your loan was 2.5 months of payroll costs. And then you had a 24-week period in which to spend those funds on qualified expenses, which is really worked out well for a lot of employers because they're only getting 10 weeks worth of payroll costs, but they have 24 weeks to spend it. So even if there was some restrictive and less employees, most were able to do that very well. So the Consolidation Appropriations Act brought about a second time draw. The additional qualifications to get a second PPP loan was a 25% reduction in gross income from 2019 to 2020 in any calendar quarter or for the year as a whole. You still had to certify that it was necessary for the continuation of your business. The amount of the loan was still 2.5 months of payroll costs, unless you have a NACIS code, which is an industry code that starts with a 72. And that NACIS code section focuses on restaurants, hospitality, tourism, those type of things. And that was definitely an industry that was hit very hard by COVID. And so they allowed for a larger draw. And the second draw loan is also a 24-week period to spend those funds. Loan forgiveness. So payroll protection loan forgiveness is due 10 months from the last day of your covered period. Part of the forgiveness, there's multiple applications depending on the value of your loan, and you need to prove the use of qualified expenses. So most of that is payroll, but there's also rent, utilities, and interest as well. So my example here is if you had a distribution date of April 10th of 2020, that means that your covered period would end September 24th of 2020. But ultimately, you don't have to seek forgiveness until July 21st of 2021. Most of the clients and local businesses that we've been assisting, we've completed that loan forgiveness much sooner than that. But it's not something to be scared of if you don't understand the process and are worried about getting it in. There's a lot of time. So I'm going to turn the time over to Sil to start on the employee retention credit.
All right. So the employee retention credit is another stimulus portion credit, I guess, that has come about because of the coronavirus, and it's been around since the beginning, since the end of March 2020 as well. It started with the same relief package as the PPP loan. There have been some changes, and that's why we're hearing more about it now, is because of the the Consolidated Appropriations Act made some retroactive changes to the 2020 employee retention credit. And we'll talk about that a little bit. Employee retention credit was set to expire in June of 2021. And with this latest American Rescue Plan Act, or ARPA, it was extended through the end of 2021. And some things to note is this credit will affect your payroll tax, your quarterly payroll tax reports, your 941. If you're taking the 2021 credit and doing it as you're filing your quarterly payroll tax reports. If you're wanting to claim the credit in 2020, then you'd have to file a 941X, which is an amended quarterly payroll tax report. And the 7200 goes along with that, and we'll talk about that a little later too. Another important thing to consider is the effect that this credit has on your tax return, your business tax filings. So whether you file a 1065 as a partnership or an 1120S, or if you have a business schedule, a Schedule C, Schedule E, Schedule F on your 1040, this employee retention credit will have an effect on those. And if you've already filed your 2020 tax return, and we'll talk a little bit more about this, but if you've already filed your 2020 tax return, then you potentially may have to amend that return if you end up claiming the employee retention credit. So, a major part of the employee retention credit is determining eligibility. And the one thing that businesses need to consider is the number of employees. Throughout this whole process, with the PPP loan, we've talked about full-time employees, and there's a limit for the employee retention credit depending on full-time employees. Now, full-time employees is not, it has a little bit different definition than what it did for PPP. If you see in red here, an employee who worked an average of at least 30 hours per week, 130 hours in any month in 2019 is considered full-time employee. And on the left here, you can see the limits for this credit. For the 2020 credit, a business can apply if they have 100 or less full-time employees. And the number jumps up to 500 or less for the 2021 employee retention credit. And other businesses that are above this threshold can qualify for the employee retention credit, but it would be based on qualifying wages paid to employees for not working. And that's a limited situation, so we won't get into that too much. But another thing to consider is there's aggregation rules when considering the full-time employee count. So separate entities under common control would be treated as a single employer for determining this full-time employee count. So it's important to consider that. Other circumstances, you can move to the next one, Candace. Other circumstances that need to be met, or other requirements that need to be met in order to claim this credit. And this is a either or. One way to claim this credit is if your business was partially closed during any portion of between March 13th to now, pretty much. So that partial closure needed to be based on a government order. So the government, whether it's state or local government, ordered your business to close fully or partially, or to order adjust your business practices in a way that had more than a nominal effect on your business operations. And that nominal effect is something that each individual business owner will have to claim And for this, the credit is based off of wages paid during the period of partial closure. And that's important as well. We'll talk about the calculation of the credit, but it is based off of wages paid. And during the partial closure, it's based off of when those closure dates were. The other test, or the other way you could qualify, is if you had a significant decline in gross receipts. And a significant decline in this situation is a 50% or more decline in gross receipts. And you would compare 2019 to 2020 to do that. You can compare the total year gross receipts or quarter by quarter. And it's important on this that your wages is based on, or the qualifying wages for the credit is based on the quarter that is below 50%, and then it continues into the next quarter until your receipts come back up to at least 80%, and we'll talk more about that. Some examples of full or partial closure that we have seen is has a lot to do with the restaurant industry. Most of us have noticed that when you've gone into a restaurant, they've closed, had every other table closed, or have only had a takeout option available. That would be a example of partial closure. We've also had medical facilities, whether eye or other medical facilities who were ordered to hold off on elective surgeries and those other things fall under this partial closure because it was an order that came from the government. And if you follow this link here, it'll take you to the IRS website that has some frequently asked questions that clarifies and helps clarify the partial closure test. So we talked about qualifying wages, and qualifying wages is based off of wages subject to Social Security and some other healthcare benefits. An important thing to consider when applying for the employee retention credit is that there's no double dipping of credits with the employee retention credit. So wages for this credit cannot be mixed with wages that have already been taken for the Family First credit or for the PPP loan. So you would take your qualifying wages and subtract the PPP loan and other credits that have already been taken, and that's an important step in the calculation of the credit. So as you see, the 2020 credit is based off of 50% of qualifying wages. And again, these are wages paid between March 13th and December 31st if you had qualified under the partial closure or the significant decline in revenues for that whole period. Okay. And so if you did qualify for the whole period between March 13th and December 31st, your maximum wages for the credit would be $10,000 per employee for the entire year. And then the credit is 50% of those wages, which would be $5,000 per employee for the year of 2020. Now, these qualifying wages, there's a few things that have to be taken into consideration. And one of them being wages paid to related individuals would reduce qualifying wages. And the list of related individuals is there. It's pretty extensive, but it's basically any close relative. Any wages paid to a close relative would reduce the qualifying wages. It's important to note that owners and owner spouses do qualify as they're considered owners before related individuals. So The 2020 credit is a little bit different. Okay, so we talked about the reduction in gross receipts. For 2020, it was 50%, but for 2021, the gross receipts reduction only has to be 20% as compared to the same quarter of 2019. So if you compare your gross receipts from first quarter of 2021 compared to first quarter of 2019, and you have a decrease in revenues by 20% or more, you would qualify for this credit for the first quarter of 2021. And now the credit amount has also been raised from 50% of qualifying wages to 70% of qualifying wages. So wages paid from January 1st to December, well, and it will continue all year, but if we're just talking about first quarter, we just ended our first quarter. So from January 1st to March 31st, 2021, maximum wages is $10,000 per employee per quarter. And so in 2020, it was $10,000 per employee per year. And so the 2021 credit is significantly more than the 2020 credit. And the maximum credit is $7,000 per employee, raised from 50% to 70%.
Okay, so we kind of wanted to just present an example. This is an actual example of a company that we did the calculation for. This one was a restaurant. So as you can see here, we just put their revenue and their income per quarter, compared it to that same quarter of 2019, just as Sil was saying. This example is for 2020, for the credits of for 2020. But as you can see, if we use just the gross receipts test, this company would have qualified for second and third quarter. And the reason that it's second and third quarter, if you look in second quarter, as Sil mentioned, their gross receipts dropped by 57% compared to 2019. They now qualify for second quarter, and the rules for the credit are that you qualify for that quarter, and then for the preceding quarters until the end of the quarter in which your receipts come above 80%. So quarter three, their receipts jumped back up to 90, basically 90% of their 2019 receipts. And so they would qualify under the gross receipts until the end of the quarter for quarter three. Now this is a restaurant, so the partial closure or full closure test is, as Sil mentioned, a lot easier to justify, in the sense that they had tables kind of closed off. They had to change their business practices to fit for COVID. So rather than taking gross receipts in this example for only second and third quarter, we decided to claim partial closure, and we were able to qualify for the entire period. So that the ERC period, as mentioned before, started March 13th, and then it continued until, at least for 2020, until the end of the year. It's for 12/31. So yeah, I think I'm going to the next slide. So this is kind of the calculation that we ran through. I did pull off a lot of the employees. Each line here, each row is a different employee and their actual wages earned during the different periods. There was more of them, obviously. Like I said, I reduced it just so we could fit it on this one screen. But if you look at the top of each column, the first column is their wages for the entire qualifying period, which we've already decided was from March 13th until 12/31 in this scenario. So that breaks down each employee's wages during that entire period. Now, this company did take a PPP loan. They received funds on April 28th, as you can see in the second column. And then this shows the amount of the same employee of their wages that was earned during the 24-week PPP period. As Sil and Candace mentioned, we can't double dip, and we need to make sure that there's enough wages to be spread across a maximum ERC and a maximum PPP. We then just separated it and basically said how much of the retention credit was used on, outside PPP period wages, and how much was used inside, the total, and then the remaining wages that we can apply to the PPP money. Now, typically, it's most beneficial, as we've done in this example, to try and maximize the employee retention credit to its full, 5,000 per employee first, and then try and use, if there's enough remaining wages for the periods, to apply PPP to that. The reason being is the ERC credit has a very defined cap. Typically, that it's not all of the employees' wages, and so we want to do that first. Now, there is scenarios, because we're now, in April of 21, a lot of companies have applied for forgiveness or received forgiveness from the PPP loan. And we have to factor that into the calculation. And in certain cases, the credit or the PPP loan uses too much of their wages for them to be able to maximize the employee retention credit. It's not 100% bad. We just have to change the order. So in this example, we did have enough wages to do the ERC first. And so if you look at the bottom left, basically it just breaks down. It says, okay, the total qualifying wages for the period was $654,000 of wages. Now, as we've discussed, each employee is capped at a maximum of $10,000 per employee. If that employee never arrives at 10,000, then they don't have to worry about it. As you can see above, a lot of this company's employees did hit the 10,000 cap. And so anything above that is obviously not qualified for the employee retention credit. So that 419,000 is taking into account basically any employee that was capped over the 10,000. So then we just take the 419 and we get 50% of that, which is the credit for 2020. So this company received the $209,000 employee retention credit. Now, and that's pretty significant. If you do look in the ERC wages used inside period, some of them are negative. I wouldn't really focus on that. That's more just how we kind of calculated the numbers. Basically, it's just saying that, there was more wages outside or inside than there was outside. But basically, after we pull off the 419,000, there is $243,000 of remaining wages that we can use PPP money. And again, they've already gotten PPP. It's not really, we're not talking about exact timing, but $243,000 left. This company received $163,000 of PPP loan. So as you can see, they had enough wages to cover the maximum of both. And so the $80,000 there at the bottom, it's not really, basically that's just saying that at the end of the day, during the period, if you count PPP and ERC, that's basically the remainder, the excess wages that they end up having to pay out of pocket, which is pretty good. Over on the right, all I did is just point out if we do end up having to do if your ERC, if doing a max ERC dips into the PPP wages and you have not filed for forgiveness, we can add some business expenses that under the rules, they let you count as PPP qualified expenses that I put on the right. Eligible non-payroll costs are business mortgage interest, business rent or lease, or business utilities. So if you have not applied for forgiveness, we can add some expenses that you have related to those to hopefully bring your costs up enough to, again, maximize both. If you have received the PPP forgiveness or already applied, then we have to do things just in a different order. And if you switch to the next slide. So this is just a different company, but they had already applied for forgiveness. And based on their wages and how much they paid during each period, kind of everything the things that I had already discussed. If we use ERC first, they actually end up with a negative remainder, which basically that just says that they've received too much benefit to pay for their wages. So then we have to swap and we have to do PPP first to account for that. Now, it doesn't really have a giant effect on this scenario. It could have a large effect. We haven't seen it in the ones that we've done. But the scenario where basically you wouldn't get much benefit from the ERC would be if your closure period or gross receipts period happens to be the exact same period as the PPP money period. And it'd be hard for this to happen, but if your PPP money covered, all or a majority of your wages for the same period, then you would, in essence, not really get any benefit from the PPP or from the ERC because you can't really double up. In this scenario, it only really affected, we only had to pull off about $2,000 of wages, which 50% of that is about, $1,200, $1,300, and that's the difference in the credit. They would have gotten $79,000, instead they got $78,000. So in this scenario, not a big deal, but we did have to take it into account.
So this little graph here just kind of details what we've been talking about and the changes that have come about between the PPP interaction and the ERC. So as you can see, the CARES Act, the original CARES Act, the PPP and ERC, that's so originally the PPP, you could do one or the other. Okay, if you got a PPP loan, you could not do the employee retention credit, and the employee retention credit was still the same. It was the maximum wages were $10,000, $5,000 per employee for employers with less than 100 full-time employees. Now, the Consolidated Appropriations Act that happened on December 27th, it was a retroactive change to ERC, saying that employers can have a PPP loan and get employee retention credit. That's why the employee retention credit it's been around this whole time. It's been around for over a year now, but it wasn't that big of a deal because most people just used the PPP loan until the Consolidated Appropriations Act happened and retroactively changed it. And so it changed. Let's see. So there's a question, I guess. Let's see. So it asks, are you finding this is where many businesses are going back and getting funds? So yeah, it has had a big effect on businesses, this retroactive change for 2020, because now they can apply even if they had a PPP loan. So most of the businesses we have helped have had a PPP loan and now are looking at getting additional assistance through the employee retention credit.
So both examples that I went through for the calculation, those were both for 2020, and those were both going back and receiving funds back. So if we were to do this for 2021 and going forward, it wouldn't be there would be no refund or return of payments because you could just do it live. But those examples, so that one company, they received $209,000 back in additional funding because of this change.
Right. And so the Consolidated Appropriations Act changed that retroactively for 2020 and proactively for 2021 through June 30th. And again, it upped or increased the maximum credit to $14,000 per employee. That would be the $7,000 per quarter for the 70%, times 2 quarters for the first and second quarter until the end of June, and increase the threshold for full-time employee count. Now ARPA extended that further to the end of 2021, and yeah, it's a great credit. So
I had myself muted, sorry. Okay, so how do you do this? The calculations that Dalton showed you all flow through to one of these forms. If you are filing a first quarter 2021 return, you can claim this before you file that return. So the line you're looking for is 11C, and that is the non-refundable portion of the employee retention credit. So they do split this credit into two pieces, non-refundable and refundable, and that calculation can be completed on the 941 worksheet. So the refundable portion of this credit is listed on line 13D on page 2 of the 941 form. And so those two numbers together will total the complete credit as you calculate it, similar to our examples that Dalton provided. Additionally, on the 941 form, page 3, you list the qualifying wage amount. That is an informational field. It's not part of the total credit you receive, but it is required to be reported. When you go to the 941 instructions, you can find the worksheet 1. This worksheet, you do have to follow steps 1, 2, and 3 because they feed into each other. The figuring of the employee retention credit is specifically in step 3, but there's several numbers that flow from step 1 or step 2 into that final calculation of the non-refundable versus refundable credit. The form 7200 is very specific to this employee retention credit for COVID-19. This allows you to get your money quicker and get your money as you go, rather than waiting for the end of the quarter and then subsequently waiting for a check to be sent to you. So the way that form 7200 works is you can complete it with every payroll period. If you had $10,000 of wages and you were getting that 70% credit, then you would get $7,000, and you would deduct the amount of 941 tax due with that paycheck run. And a 941 tax, again, is federal income tax, Social Security tax, Medicare tax. And so you can really help with cash flow by using this form 7200 and getting your money sooner. This form is faxed to a fax number, so that typically means the IRS will get to it quicker. What we're seeing with the employee retention credit when we have to file a 941X, which we'll talk about in just a second, is the IRS is saying they have, a lot of paper returns that haven't been processed because the IRS hasn't been fully functioning. They've had COVID restrictions as well with their staff. And so the paper filing of any return is being delayed more than usual. So if the cash flow is necessary now, this form 7200 is really important. So for those that are going retroactive, or maybe even if your first quarter 941 has already been filed for 2021, the form you need to file is a 941X. A 941X is used for multiple purposes, but in this case, we're focusing on employee retention credit. And it allows you to claim a refund or get your money back. So you use the same 941X despite which quarter it is, and you just have to notate on each page which quarter. So we do mark box 2, which is to claim a refund. And then on part 2, we are using box 5C that says that the refund that you're claiming has nothing to do with anything that was withheld from the employee's paycheck. So on the 941X, the line numbers are a little bit different. So the non-refundable portion of the employee retention credit is line number 18. If you've never done a 941X, you only have to complete the fields that are different. So you do not have to enter all the original information, only if the original information is changing. So for the most part, line 18, you will be entering zeros in the original reported and the amount of refundable credit in column 1, which will then come over to column 4. That subtotal will come forward to where you'll find the refundable portion of the employee retention credit, which is line 26, and will be combined for the total. It's important to note that even though this credit started March 13th of 2020, you will never file a 941X for first quarter of 2020. If you have wages from March 13th to March 31st, that will be filed with your second quarter amended, and those qualifying wages for first quarter will be identified separately on line 33A, which specifically talks about that period of qualified wages as well. We have a question, so one second. So the last part of the 941X is how you describe why you're filing an amended return. So these are 2 different examples that we've provided, and they are due to legislative changes enacted December 27th of 2020. The taxpayer is now eligible for the employee retention tax credit. There was a partial closure of the business during the period, and then you can identify the period. So that would be applicable for partial closure. The next one is similar, but it's based on the reduction of gross receipts. When it comes to providing explanations, the more information you can provide, the less questions that will potentially come back. And so providing why you qualify and why you're making the changes is really important. So if you receive this credit, so in our example, the business owner who received $209,000 of employee retention credit, this is not tax-free like the Payroll Protection Program loan forgiveness is. This will be taxable. So as they file their business tax return, whether on whichever kind of form it is, they would reduce the amount of wages. So their total wages were $600,000 for the year. If they got $209,000, then they would only report that $390,000 of wages as an eligible expense. And this does have to be completed on their 2020 return because that's where the qualified wages are. It can't be pushed forward to 2021 when they actually receive the cash, even if they are a cash basis taxpayer. So we call this a taxable credit, meaning if your business income was $100,000, net income was $100,000 before the credit, it now will be $309,000. And if that's a flow-through entity or a corporate return, there is going to be tax consequences. Okay, so this restaurant and special venue operators grants, these are full-fledged grant programs. I've watched several webinars on these put on by the SBA, but these are not a simple application. These are not going to be quick turnaround information, and there is a lot of back-end reporting for these type of programs. Currently, we've not assisted anybody with these, and the restaurant grant itself is not up and running yet. So there's still additional clarification to come out on that grant. The special venue operators grant was supposed to roll out April 9th. I have a friend who's doing this grant as part of her position, and the entire portal collapsed. And I even looked last night to see if it was back up and running, and they hadn't gotten it back up and running yet. So there are a lot of venues that lost a lot of revenue because of the restrictions in traveling, and that is what these are focusing on. Just know if you're smaller, that there's going to be a lot of complexity to these type of programs, and you'll have to outweigh the cost benefit on them. What other questions do we have out there?
This is Colette. I have a question, just going back to the last slide. You said that for smaller businesses, they should really consider if this is something they want to go after. Is that more for the special venue, or is that more for the restaurants? Is it easy? Does it look like it's going to be more of a clear path to getting the funding for restaurants versus the special venues?
So they haven't put out much information on the restaurant grant yet, unfortunately, but where they're going to be using the same type of platform that they are for the special venue grants, I do think it's still going to be pretty complex. And for the most part, a lot of their limits are high limits. Like they're saying some of these people may get $2 million up to $10 million in grants. And when you're talking about that much funding, the complexities are definitely going to be higher.
So this is really, would you say that this program in particular is really focused on very large venues? So for an example, here in Southern Utah, like Tuacahn, who, you know, had to cancel shows and things like that, as an example of a special venue. It's a very large venue.
Yes. Yep. Maybe the Shakespeare Festival in Cedar City. I don't know all the particulars about either one of those, but yes, those would be the type of complex structures that need these fundings that probably haven't been helped enough by some of the smaller programs.
The businesses that I really see taking advantage of this program are area restaurants that again were hit, and with either by seating limits or by, you know, loss of the flow of traffic. And with this program, is for the restaurant side, does it look like it will be okay to layer it with all of the other programs that you spoke about, the PPP and the ERC? And
from what we can tell, yes. I know that originally the special venue grant had said if you get a PPP2, you're not eligible. And
okay.
they came back and said, you'll still be eligible, but we'll take your PPP2 as a reduction of what's available to you. So I do feel like that they're going to do the same type of thing for a restaurant. If you're getting a second round of PPP, then you just may have a top of the line deduction on what you actually receive for your grant.
Okay, it's really good information. And it looks like we've got a question from Sherry here in the chat. She said, if we receive the USAF grant and the revised PPP loan, can we apply for the new grant?
So I'm not familiar with the UDAF. Can you give me the full name of that program?
That is the Utah Department of Ag. Got that grant almost just right after the shutdown started. We're a small product manufacturer in Southern Utah. We have a goat dairy, and then we make caramel sauce and soap from the products. We also sell the milk. And we were affected by the lack of market space. We go to festivals, and the festivals were all shut down. We did 4 festivals last year instead of 13 that we had scheduled to do. So we know we had a loss. I don't know. I'm a product manufacturer myself. Our other partner here is the actual accountant. She takes care of everything. And when I asked her today, could she or would she be willing to go back into 2019 and 2020 and pull out the 4 months that we were the worst performing and measure that against next year? And she didn't seem to think it'd be worth it.
So I would say, I don't know specifically on the ag grant, like what it was for, but as long as you're not using dollar for dollar the same money for, so for example, if UDAF was for payroll specifically, you just want to make sure that you have enough to cover all the different types of programs rather than using the same dollar for multiple credits or multiple programs. And just be careful, it's not necessarily a 4-month period. You're gonna have to do calendar quarters for all the programs that I've talked about. So we had several clients that wanted to do March, April, May, because those were the worst months. However, the programs that I've talked about today, when you talk about comparing quarter over quarter, those have to be calendar quarters, even if you're a different period end for financial statement or tax reporting. They've been very specific that those are calendar quarters.
Another question is, they've got information that came out from the Governor's Office of Economic Development talking about the Impacted Small Business Catalyst Grant. And so that's something that's coming out through the state. Is that, again, something that businesses should apply for in addition, or will it be able, small businesses layer that funding along with the PPP and everything else that you're aware of?
I would say yes. I'm not specifically aware of the Impacted Small Catalyst grants, but I did do payroll protection program and the commercial rent program that the governor's office did last year. The economic development office from the state of Utah did commercial rental last year. And so we did layer those together and we focused on making sure we didn't use the same dollars for both programs.
And I know that Shari just mentioned that her partner that does the accounting said, gosh, we don't know if we want to go back, if it's worth it. Are you finding that small businesses, if they're pulling this information for one grant or one program, that it's similar information for other programs? And would you say, would you encourage them to pull the information and really go for these funds?
I think so. I try to keep, you can usually do some sort of calculation without doing a lot of data mining or like historical records by looking at some really high things like how many employees do you have? So what's going to be my potential gain? We can do, if I have 10 employees and they all meet that $10,000 in a year, then I'm looking at a $50,000 credit. So is it worth looking into that for me? And for me, that's a yes. When it comes to things like that. So, and then when it comes to gross receipts, a lot of times you can make that very simple, like pulling some bank statements for 3 months. And so maybe it's easier to go pull some business bank statements for, the last 3 years and doing some totals there. So hopefully there is some records that may be a little easier to access like that to do an initial inquiry to see if you're going to qualify.
And on average, what is give us an average range of the amount that some of these businesses are recuperating after they've gone back to apply for like the ERC, even though they got PPP, or the average amount that they're getting from these programs if they do go ahead and do the data mining and get the time or get the application in?
That range is really wide and varied, which I think goes to say that we have some very big clients and we have some very small ones. The smallest one I've seen is still $5,000. And that's for a single person, and it was a nonprofit. So $5,000 to a nonprofit is huge. We've had some other like salons or things like that only have a handful, maybe under 10 employees, get something like $10,000 back. And then we've had some really large restaurants that have gotten almost $500,000. So it really ranges just based on, the complexity of the client and the number of employees that they have and that they're able to keep employed.
That's fantastic. Thank you so much.
So there's another question, sorry. And then, so there was a couple of things that I didn't cover with PPP that came to mind as waiting. So the payroll protection program is still open. It's open till the end of May, as long as the funding does not run out. And so if you did receive a first draw in 2021, you are potentially eligible for a second draw in 2021, where when it was supposed to be closing the end of March, that wasn't an option. Additionally, if you're a Schedule C and you have not yet received a PPP loan, there is new calculations out there that you actually get to get your PPP loan based on your gross income rather than your net income, which can be a huge difference for Schedule C filers. Additionally, with farms, so this may help you, Sherry, I think they're looking at gross calculations for some of those new PPP loans for farms and Schedule C. So it's really important that you get with a banker. We've worked with a lot of the different banks around here, Wells Fargo, Zions, Cash Valley, State Bank. Cash Valley has been phenomenal, even to its non-customer clients. And so if I can't always answer all the very specific and technical questions, but because the bankers have a direct contact with the SBA, a lot of times they can get those very specific technical questions answered when it kind of deviates from the rules, or maybe it's in that gray area of whether you qualify.
Thank you. We work with State Bank, and State Bank was able to get us the last one, but I just feel like we're still maybe $3,000 or $4,000 shy of where we should have been. Unfortunately, it doesn't count for any rapid growth. It just brings you back to even, So that's what we're looking for. Thank you.
You bet.
I don't see any other questions. Do we have any other last questions from the audience? Or anything to add from Dalton and Sil?
Nothing from us. We're good. Thanks for having us.
Well, thank you for attending our first Better Your Business Express training. Please be sure to click on the evaluation link in the chat. Tanner, if you could, or Colette, add that link to the chat. We will also be emailing the evaluation form out to those of you who have registered. There it is. So please be sure to fill out that evaluation and let us know how we're doing, and also let us know if there is any specific training that you're looking for that will help your business recover and reopen. Be sure to register for our upcoming trainings. The next one is on April 20th at 10 a.m. The Ready, Set, Reopen, Customer Service and Positioning Your Business. The next one is Website Design for the Online Marketplace on April 21st at 10 a.m. And our fourth and last of this spring series is HR Employment Laws on May 12th at 12 p.m. I'd like to thank Candace, Sil, and Dalton at Hinton Burdick for giving us the most current information on the variety of CARES funding programs still available. We hope you have a wonderful day. Thanks for joining us.